So in the first video we discussed that the value of the Australian dollar is a floating exchange and therefore it's basically determined by demand and supply. In this video we're going to talk about all the factors that can influence demand and supply for the Australian dollar. So what causes demand for the Australian dollar? What causes the dollar to appreciate? Because foreign currencies are demanding more Australian dollars. Okay, one thing, if overseas citizens purchase more Australian exports. If we're exporting more, there's more demand for our currency because they need our currency to buy our exports. So their currency gets converted into ours and therefore the dollar appreciates. If our interest rates are high, that leads to more demand for our dollar because essentially people want to put their money in our banks. The rate of return from investing in Australian banks is really high. So a lot of foreign citizens are going to be placing their money, their cash, in Australian banks in order to get a higher return. So that will lead to more demand for our currency and therefore an appreciation of the dollar. Whenever we lend money from overseas countries, again, that's a credit. Remember, any credits are going to be appreciations. When we lend money from overseas, they're essentially giving us money. So therefore, that's going to lead to an appreciation of the dollar in the short term. Often countries are willing to lend. Often Australians will borrow from overseas when there's high interest rates in Australia because it's too costly to borrow in Australia, so they borrow abroad. So often when there's high interest rates in Australia, we lend more from foreign citizens. We borrow more from foreign citizens because it's too costly to borrow in Australia. Overseas citizens buy Australian property, they have to pay us money, or they invest in Australian firms, they have to pay money. So any form of equity investment, any credits in the financial account would be included as a demand for the dollar. We receive income for shares we have in foreign companies. So when we receive dividends in shares, that would be an example of a demand for our dollar. Whenever Australian companies working overseas receive profits. So these are credits in our current account. Basically, when we purchase the companies, it would have been supply of the dollar, or when we purchase those shares, but now that we're receiving the dividends or the profits, that is demand for our dollar. When foreign citizens think our dollar will appreciate, they are likely to demand our dollar as well because they think it's going to go up, and therefore they want to have our currency because they'll make money out of it. This is basically exactly the same thing. Just a summary, our dollar will appreciate when we export more, when overseas investors invest more in Australian firms, when speculators think the dollar is going to rise, when overseas citizens buy Australian property, when there's high interest rates in Australia, and when overseas nations lend Australia money, or we borrow money. What causes supply of the Australian dollar? Supply is when the Australian dollar is supplied to the forex market. So we do that when we purchase imports. Again, this is all debits. Keep that in mind. These are all debits in the current and financial accounts. The easiest way to describe the supply of the Australian dollar. Think debits and just link it straight to supply and you'll be on the right track. So imports, when we travel overseas or give foreign aid, they're debits in the current account. When we purchase foreign assets or invest overseas, so if you set up a business overseas, that's a debit in the financial account because we're giving them money initially. If Australians open up businesses overseas, same kind of thing. Whenever we pay interest on our debt, it's going to lead to a debit in the current account. And again, we're paying them money, so we're supplying the Australian dollar. If we pay dividends on shares or rent on property, again, the Australian dollar gets supplied to the forex market. Okay, so purchasing imports, purchasing foreign assets, paying interest on our debt, higher interest rates overseas. So when Australia's interest rates are low and there are high interest rates overseas, we're more likely to invest overseas. So we're more likely to put our banks in foreign banks, and that's going to create more supply of the Australian dollar. Okay, because we're going to give them our money, and therefore the Australian dollar is being converted into foreign currency, and that's the supply of the Australian dollar. If you open up a business overseas, if there's a global recession, that's likely to lead to mainly less demand for the Australian currency because there'll be less demand for our exports. We might import slightly more because the price might be cheaper as well. Okay, here's your big table. You've got to be able to tell if something increases demand for our dollar, decreases demand for the Australian dollar, or if there's more supply of the Australian dollar or less supply of the Australian dollar. So some examples of things that cause more demand for the Australian dollar. These are things that are going to cause the dollar to appreciate because essentially there's more credits coming into Australia. Okay, high demand for our exports or high commodity prices, because again they have to exchange more of their currency into ours. If we borrow from overseas, high interest rates in Australia, again we want to put our money, so foreign citizens want to put their money in our banks, we want to borrow from abroad, so that's again going to lead to currency being converted into Australian dollars. Australians sell assets or shares to foreigners, again it's going to lead to credits in our financial account. So any direct or portfolio investment credits will be demand for the Australian dollar. Australians receive dividends on profits. So we have shares overseas, they pay us a dividend. That's Australian demand for the Australian dollar. Speculation the dollar will rise, people will want to buy it now. Strong overseas growth also leads to the dollar appreciating because we export more. Less demand for the Australian dollar. So this is basically meaning we're exporting less, or there's less people putting their money into our banks or something like that, as opposed to us importing more, which is increased supply. So at the moment we have lower commodity prices in Australia. That's basically meaning that foreign currencies have to convert less of their currency into ours, so therefore there's less demand for the Australian dollar. So instead of converting, $100, they're only converting $50 because it's cheaper. So there's less demand for our currency. Less exports. Reduced productivity in Australia, so we might export less, and therefore there'll be less demand for our dollar. Lower overseas growth can lead to us exporting less credits. Low interest rates will reduce the demand for the Australian dollar because less people will want to put their money in our banks, and less faith in the Australian economy because they're not going to let us borrow, or they're not going to lend to us because they think that we're too much of a risk. More supply of the Australian dollar. Again, this is just thinking of debits. Anything that's increasing debits, more supply. So imports or foreign aid. If you go on an overseas holiday, if we pay any interest, dividends or profits on our current account. Australians invest overseas, so if we were to buy shares, again, it's a debit. This time it's in the financial account, but it's more supply. Australians set up businesses overseas. Again, we have to pay money. That would be a debit. Any secondary income debits, so if we give foreign aid. If there's strong consumer confidence in Australia, this is a pretty difficult one. We often import more, so that will lead to more supply of the Australian dollar. Or if there's low interest rates in Australia, we're going to invest abroad, so that will create more supply of the Australian dollar. Less supply of the Australian dollar basically means we're importing less. So that could be because we have higher unemployment, so there's not as much import spending. High interest rates in Australia, that will lead to us putting less of our money in foreign banks and more money in Australian banks. So that kind of goes both. It can lead to more demand because foreign citizens put their money in our banks, and higher interest rates can lead to less supply because we don't put our money in their banks. Successful campaigns to get people to buy Australian-made products in Australia means that we're not buying as many imports, therefore less supply. Cheap overseas interest rates kind of basically means we're not putting our money in foreign banks. Decreased oil prices, that's a big one, reducing supply at the moment because it's not costing as much to buy oil. Loss of confidence in foreign currencies. Terrorist attacks, less people would go overseas. Low inflation in Australia is another good one. That would mean that there'd be more demand for the Australian dollar, so it could also go in this column here, the first column, but it will also lead to less supply because we will import less. So just to finish off, suppose Australia's interest rates are increased. So we've got high interest rates, while the interest rates of our major trading partners remain unchanged. If we have high interest rates, people are going to want to invest in Australia, and we're less likely to invest abroad. So there will be less supply of the Australian dollar. We will supply less of the Australian dollar because we want to invest in Australian banks, and that will cause the TWI to increase.